Picture this. The world's biggest banks and asset managers are quietly moving trillions of dollars in tokenized assets and repo trades every month. But most of it is happening in what looks like a parallel universe, not fully on the open, public Ethereum that powers DeFi and most of crypto. Not on some completely isolated private chain either. It's something in between. A shadow network of confidential rooms and layers built on or anchored to Ethereum. Why? Because pure public chains are too transparent for them, and pure private chains might be too fragile and fragmented in the long run. Today we're diving deep into the real conflict between public and private blockchains and why the winning architecture might look very different from what either side is loudly claiming. Setting the stage, the Great Divide. Blockchain technology was supposed to be this great equalizer, transparent, decentralized, permissionless. But when the biggest institutions in the world started seriously looking at it for real financial infrastructure, a massive tension emerged. On one side, public chains like Ethereum mainnet and its L2s, everything is visible to anyone with a block explorer. Composability is God tier, smart contracts can talk to each other seamlessly. Liquidity is deep. Security comes from thousands of independent nodes and years of battle testing. No single company can turn it off or change the rules unilaterally. On the other side, private or permissioned chains like the Canton network, backed by Goldman Sachs, JPMorgan, DTCC, and hundreds of others. Privacy is built in by design, selective disclosure, private ledgers per participant, sub-transaction privacy. Compliance, KYC/AML, is easier. Governance is controlled by known players. They can move fast on regulated use cases. The conflict is simple but profound. Institutions need confidentiality for competitive reasons, fiduciary duty, and regulation. Public chains give radical transparency by default. Private chains give control and privacy, but often at the cost of openness and long-term resilience. Why institutions struggle with pure public chains. Here's the practical problem. If you're a bank or asset manager moving serious money, every transaction on a fully public ledger is like broadcasting your entire trading book to the world, including competitors. Position sizes, counterparties, timing, strategies, all potentially visible through on-chain analysis. That's not just inconvenient. It can be a fiduciary breach or regulatory headache. Under rules like GDPR or MiCA that emphasize data minimization, we've heard it directly from industry voices. Big players won't publish every trade on chain. It clashes with how traditional finance has always operated behind, somewhat, closed doors for legitimate business reasons. That's why we've seen massive activity on permissioned networks. Canton Network, for example, is reportedly processing around $9 trillion in monthly transaction volume, with hundreds of billions daily in repo trades involving DTCC, JPMorgan, Broadridge, Goldman Sachs, Visa, and 600+ institutions. They've built real production infrastructure for tokenized assets and settlement. Pure public Ethereum, while dominant in DeFi and early RWA experiments, hasn't captured the same scale of institutional settlement flows yet, partly because of this transparency issue. Why pure private chains have their own problems, long-term. But here's where the story gets interesting, and where some narratives need correcting. Private chains solve the immediate privacy and compliance problem beautifully in the short term. Canton's architecture with DAML smart contracts allows atomic settlement while keeping data need to know. It's pragmatic and working today. However, they come with structural trade-offs that become bigger problems over time. First, trust concentration. You're trusting operators and a consortium of validators. Failures can be correlated. One domain down affects connected transactions, no independent global verification like thousands of public nodes. Second, fragmentation in silos, limited composability. Hard to interact seamlessly with the broader ecosystem or DeFi liquidity. Bridges or intermediaries reintroduce counterparty risk. Third, governance and control risks. Rules can potentially be changed by the controlling entities, less credible neutrality. Potential for vendor lock-in or regulatory capture of the network itself. Fourth, liquidity and network effects. Smaller overall liquidity pools. Harder to achieve the flywheel of open innovation that public chains enjoy. Fifth, long-term security. They lack the decentralized resilience of mature public networks. JPMorgan analysts have even flagged institutional preference for these permissioned networks as a potential structural risk to public chains like Bitcoin and Ethereum. The shadow solution, cryptographic privacy on public rails. This is where Ethereum's approach stands out and why the shadow institutional network on Ethereum is so compelling. Instead of forcing institutions into fully public view or fully private silos, the ecosystem is building cryptographic privacy layers that let sensitive operations happen confidentially, while anchoring to the public chain for security, settlement, liquidity, and composability. Key developments. The Ethereum Foundation's Institutional Privacy Task Force spent a year working with banks. That team has now spun out into EthSystems, a for-profit company backed by major ETH treasury firms like Bitmine and SharpLink, focused on building exactly these confidential systems for institutional use. They've already shipped open-source work on private bonds, confidential stablecoin transfers with compliance hooks, private cross-chain settlement, and privacy-preserving identity. Complementary tech includes ZK rollups and confidential L2s like Aztec for private smart contracts, and ZK sync Providiums for enterprise private instances anchored to Ethereum. Tools like Railgun for on-chain ZK privacy, TEEs and emerging FHE for confidential compute, standards for selective disclosure, prove compliance without exposing everything. The vision. Institutions get private rooms for sensitive flows while the proofs or commitments settle on public Ethereum. You get cryptographic guarantees instead of trusting operators. The vision. Institutions get private rooms for sensitive flows while the proofs or commitments settle on public Ethereum. You get cryptographic guarantees instead of trusting operators. Composability with the deepest liquidity, no single point of control, self-sovereign exit. This is the hybrid shadow model, invisible where it needs to be but verifiably anchored to the decentralized public network. Head-to-head comparison, private chains versus Ethereum privacy stack. Let's make this concrete. Privacy model. Canton is trust-based. Ethereum is cryptographic, using ZK and encryption. Composability and liquidity. Canton has limited siloed domains. Ethereum offers full DeFi interoperability and the deepest on-chain liquidity. Security and decentralization. Canton is operator-dependent with correlated risks. Ethereum has thousands of nodes and is battle-tested. Compliance. Both can do it, but Ethereum layers allow verifiable selective disclosure. Long-term risks. Private chains face fragmentation and lock-in. Public hybrids preserve openness. Real volumes today. Canton is winning short-term production volume in repo and tokenized assets. But the architectural advantages of public chains, neutrality, decentralized security, the liquidity flywheel, position them to win the larger long-term game as the tech matures. Real-world momentum and examples. We're already seeing this play out. Canton is live with serious flows. Ethereum has BlackRock's BUIDL and other tokenized products, plus growing RWA activity. JPMorgan has explored both its own Kinexes, permissioned, and public L2s like Baze, while the broader ecosystem pushes hybrid privacy solutions. EthSystems is turning research into production tools. Ethereum Institutional acts as the front door for banks navigating this. The momentum isn't one or the other, it's institutions experimenting with hybrids. Private for sensitive parts, public for settlement and auditability. Bull case, risks, and realistic timeline. The bull case for the shadow/hybrid Ethereum model. Massive capital efficiency, freed up collateral moving 24/7. New tokenized markets. Stronger Ethereum as the settlement and security layer. Network effects compounding as more volume anchors to it. Better alignment with cypherpunk values. Cryptographic truth over operators. Risks and challenges. Technical complexity and UX for institutions. Regulatory uncertainty around privacy tech. Execution risk on the privacy layers maturing fast enough. Private chains could entrench if hybrids are slow. Timeline. Short term, now to 2027. Private networks like Canton continue gaining volume. Medium term, 2027 to 2029. Hybrid privacy solutions on Ethereum scale in production as tools mature. Long term, public Ethereum becomes the default neutral backbone, with private instances as specialized extensions rather than competitors. What this means for crypto, DeFi, and retail. For retail and DeFi builders, this is ultimately bullish for Ethereum. Institutional volume brings legitimacy, deeper liquidity, and better infrastructure. It doesn't kill open DeFi. It can coexist and even enhance it through better rails and selective composability. The danger is if private chains win too decisively and fragment liquidity into closed systems. That's why supporting open standards and cryptographic privacy on public rails matters. Retail holders benefit from a stronger ecosystem, but should understand the shift toward hybrid infrastructure. Balanced conclusion. The conflict between public and private isn't a simple winner-take-all. Private chains delivered real results fast where public ones couldn't yet meet compliance needs. But they risk recreating the very silos blockchain was meant to disrupt. Ethereum's shadow institutional network offers a path that preserves neutrality, resilience, and open innovation, while solving the practical barriers for big money. It's not perfect or finished, but it's the architecture that aligns incentives for the long game. The institutions aren't choosing between crypto and TradFi anymore. They're choosing how to bring the best of both together. And the public chain with strong privacy tech is positioning itself to be the foundation. What do you think? Will cryptographic privacy on public Ethereum win out, or will permissioned networks dominate institutional flows? Drop your thoughts in the comments. Subscribe and hit the bell for more. If this deep dive on the real infrastructure battle resonated, hit subscribe for more on tokenized assets, institutional adoption, and the future of finance. Next video, we're looking at another under-the-radar development. This is signal and noise. The shadows are where the real infrastructure is being built. Stay curious, stay informed, stay sharp, stay focused, stay updated. See you next time.